Question 1. The evaluation methodology shows that Avery Dennison's internal audit team has identified potential discrepancies in the preliminary financial data for the upcoming quarterly report. The team is considering two primary approaches to address this: immediately releasing the preliminary data with a disclaimer about potential inaccuracies, or conducting a more extensive review to verify all figures before any release. Which approach best aligns with regulatory requirements for financial reporting? Option A. Release only the positive financial metrics and withhold the negative ones until further review. Option B. Conduct an extensive review to verify all figures before any release of financial data. Option C. Release the preliminary financial data immediately with a disclaimer about potential inaccuracies. Option D. Delay the release of the quarterly report until all discrepancies are resolved, regardless of reporting deadlines. Correct answer is B. Conduct an extensive review to verify all figures before any release of financial data. Explanation: this scenario presents a professional challenge because Avery Dennison, as a publicly traded company, must adhere to stringent financial reporting regulations. The challenge lies in balancing the need for timely and accurate financial information with the potential for misinterpretation or premature disclosure of sensitive data. Careful judgment is required to ensure compliance with all applicable laws and ethical standards, particularly those governing financial disclosures. The correct approach involves a thorough review of internal controls and data integrity checks before any financial information is released. This ensures that the data presented is accurate, complete, and compliant with all regulatory requirements, such as those mandated by the Securities and Exchange Commission, SEC, in the United States. This approach upholds the principles of transparency and accuracy in financial reporting, which are fundamental to maintaining investor confidence and avoiding regulatory penalties. An incorrect approach would be to release preliminary financial data without adequate verification. This could lead to the dissemination of inaccurate information, potentially misleading investors and the market. Such an action would violate the SEC's rules on fair disclosure, Regulation FD, which prohibits selective disclosure of material non-public information. Another incorrect approach would be to delay the release of verified financial data beyond the mandated reporting deadlines. This would also constitute a regulatory violation, potentially resulting in fines and reputational damage. A third incorrect approach would be to selectively disclose certain positive financial metrics while withholding negative ones, which would be a clear breach of ethical conduct and regulatory requirements for comprehensive and unbiased reporting. Professionals should employ a decision-making framework that prioritizes regulatory compliance, ethical integrity, and accuracy. This involves establishing robust internal processes for data collection, verification, and reporting. When faced with potential disclosure challenges, professionals should consult with legal and compliance departments, conduct thorough risk assessments, and ensure all disclosures are made in accordance with established policies and regulatory guidelines. The focus should always be on providing a fair and complete picture of the company's financial performance. Question 2. The control framework reveals that a sales representative at Avery Dennison is in discussions with a potential new client. During a meeting, the client expresses strong interest in Avery Dennison's products, but mentions that they are also considering competitors, and that a small gesture of goodwill from Avery Dennison would significantly influence their decision. The sales representative is eager to close the deal and meet their quarterly targets. Which of the following actions best aligns with Avery Dennison's commitment to regulatory compliance and ethical business practices? Option A. Proceed with the sale, assuming the small gesture of goodwill is a minor request that will not impact Avery Dennison's compliance obligations and focus on meeting the sales target. Option B. Accept the client's offer of a token of appreciation before finalizing the contract, as it is a common practice in some industries and would help secure the deal. Option C. Inform the client that Avery Dennison does not engage in any form of preferential treatment or inducements and politely decline to discuss the matter further, even if it means losing the potential business. Option D. Document the client's statement about a small gesture of goodwill and immediately consult Avery Dennison's compliance department for guidance on how to respond appropriately without violating any regulations. The correct answer is D. Document the client's statement about a small gesture of goodwill and immediately consult Avery Dennison's compliance department for guidance on how to respond appropriately without violating any regulations. Explanation: this scenario is professionally challenging because it requires an employee at Avery Dennison to navigate potential conflicts between business objectives and regulatory compliance. The pressure to meet sales targets can create an environment where shortcuts or ethically questionable practices might seem appealing, but adherence to the law and internal policies is paramount. Careful judgment is required to identify and address potential compliance risks proactively, ensuring that Avery Dennison operates with integrity and avoids legal repercussions. The correct approach involves meticulously documenting all interactions and communications related to the potential client, ensuring that no promises are made that could be construed as inducements or violate anti-bribery regulations. This approach upholds Avery Dennison's commitment to ethical business conduct and compliance with relevant laws. Specifically, it aligns with the principles of transparency and accountability expected in business dealings, preventing any appearance of impropriety or violation of regulations that prohibit offering or accepting improper benefits. An incorrect approach that involves accepting the client's offer of a token of appreciation before securing the contract is professionally unacceptable. This action could be interpreted as a bribe or an inducement, violating anti-bribery and corruption laws. It creates a significant compliance risk for Avery Dennison, potentially leading to severe penalties, reputational damage, and legal action. Another incorrect approach, which is to proceed with the sale without addressing the client's request for preferential treatment, is also professionally unsound. While it might seem like a way to avoid immediate conflict, it fails to address a potential compliance issue. If the preferential treatment requested is indeed a violation of Avery Dennison's policies or relevant regulations, ignoring it does not absolve the company of responsibility. It could lead to unfair competition or other regulatory breaches. The professional reasoning process for such situations should involve a clear understanding of Avery Dennison's code of conduct and all applicable laws and regulations. When faced with a situation that raises compliance concerns, an employee should first pause and assess the situation against these established guidelines. If there is any doubt, seeking clarification from the compliance department or legal counsel is the most prudent step. This ensures that decisions are made with full awareness of the potential risks and in accordance with the highest ethical and legal standards. Question 3. Examination of the data shows potential inaccuracies in the reported revenue figures for Avery Dennison's recent quarterly filing. The finance team has identified several discrepancies that, if material, could impact the overall financial picture presented to investors. What is the most appropriate course of action for Avery Dennison to ensure regulatory compliance and maintain financial integrity? Option A. Proceed with the current filing as planned, assuming the discrepancies are minor and will not significantly affect the overall financial results, and address them in future reporting cycles if they persist. Option B. Rely on the initial data as presented and issue the quarterly filing without further scrutiny, attributing any minor variances to normal business fluctuations. Option C. Immediately investigate the discrepancies thoroughly, involving relevant internal departments and potentially external auditors, to determine their nature, cause, and materiality, and to implement necessary corrective actions, including potential restatements, while meticulously documenting all steps. Option D. Instruct the finance team to make minor adjustments to the current figures to smooth out the discrepancies without a formal investigation, to avoid delays in the filing. The correct answer is C. Immediately investigate the discrepancies thoroughly, involving relevant internal departments and potentially external auditors, to determine their nature, cause, and materiality, and to implement necessary corrective actions, including potential restatements, while meticulously documenting all steps. Explanation: this scenario presents a professional challenge because Avery Dennison, as a publicly traded company, is subject to stringent regulatory requirements regarding the accuracy and completeness of its financial reporting. Misrepresenting financial data, even if unintentional, can lead to significant legal repercussions, regulatory sanctions, and damage to the company's reputation and investor confidence. The core of the challenge lies in balancing the need for timely reporting with the absolute requirement for accuracy and compliance with relevant accounting standards and securities laws. The correct approach involves a thorough and documented investigation into the discrepancies, involving relevant internal departments and potentially external auditors, to identify the root cause of the errors. This approach prioritizes adherence to generally accepted accounting principles (GAAP) and relevant securities regulations, such as those enforced by the Securities and Exchange Commission (SEC) in the U.S. By meticulously documenting the investigation, corrective actions, and any necessary restatements, Avery Dennison demonstrates a commitment to transparency and regulatory compliance, which is ethically sound and legally mandated. This proactive and thorough method ensures that any reported financial information is reliable and that the company is meeting its disclosure obligations. An incorrect approach would be to ignore or downplay the identified discrepancies. This could involve attempting to correct the errors without a formal investigation or documentation, or worse, proceeding with reporting the inaccurate data. Such actions would violate fundamental accounting principles and securities laws, which mandate accurate financial reporting. Failing to investigate thoroughly could lead to the perpetuation of errors, making future reporting even more unreliable. Attempting to conceal or minimize the impact of errors would constitute a breach of fiduciary duty and could be interpreted as fraudulent intent, leading to severe penalties. Another incorrect approach would be to rely solely on the initial, potentially flawed data without seeking independent verification or expert consultation, thereby failing to exercise due diligence. Professionals facing similar situations should adopt a systematic decision-making process. This involves 1. Recognizing and acknowledging the potential issue immediately. 2. Initiating a comprehensive and documented investigation to understand the scope and cause of the problem. 3. Consulting with internal legal and compliance teams, as well as external auditors if necessary, to ensure adherence to all applicable regulations and accounting standards. 4. Implementing appropriate corrective actions, which may include restating previously issued financial statements if the errors are material. 5. Ensuring all actions are thoroughly documented for audit and regulatory review. This structured approach ensures that decisions are not only compliant, but also ethically sound and protect the interests of the company and its stakeholders. Question 4. Assessment of the appropriate action for an Avery Dennison employee who discovers that a key supplier they are responsible for managing has hired their sibling for a significant role, potentially impacting contract negotiations and oversight. Option A. Inform the supplier that the relationship must be managed by someone else due to the conflict of interest. Option B. Discreetly adjust contract terms to favor Avery Dennison, believing the familial connection can be leveraged for better outcomes. Option C. Immediately disclose the familial relationship to Avery Dennison's compliance department and await guidance on managing the situation. Option D. Continue managing the supplier relationship as usual, assuming personal integrity will prevent any undue influence. Correct answer is C. Immediately disclose the familial relationship to Avery Dennison's compliance department and await guidance on managing the situation. Explanation. This scenario presents a professional challenge because it requires an Avery Dennison employee to navigate potential conflicts of interest and uphold the company's ethical standards and compliance obligations. The core difficulty lies in balancing personal relationships with professional responsibilities, ensuring that decisions are made impartially and in the best interest of Avery Dennison, rather than being influenced by personal connections. Careful judgment is required to identify and manage situations where a perceived or actual conflict of interest could arise. The correct approach involves proactively disclosing the relationship to the appropriate internal channels at Avery Dennison. This demonstrates transparency and allows the company to assess the situation and implement necessary safeguards, such as reassigning responsibilities or implementing enhanced oversight. This approach aligns with Avery Dennison's commitment to ethical conduct and compliance, as typically outlined in corporate codes of conduct and policies regarding conflicts of interest. Such policies are designed to prevent undue influence, favoritism, and potential breaches of confidentiality or fairness, thereby protecting the company's reputation and operational integrity. An incorrect approach would be to proceed with the business relationship without disclosure, assuming personal integrity is sufficient. This fails to acknowledge the potential for unconscious bias or the appearance of impropriety, which can erode trust and create legal or reputational risks for Avery Dennison. It violates the principle of transparency and the duty to act in the company's best interest, potentially contravening internal policies and ethical guidelines that mandate disclosure of such relationships. Another incorrect approach is to attempt to manage the situation independently by downplaying the significance of the relationship or the potential for conflict. This is problematic because it bypasses established company procedures for conflict of interest management. It assumes the employee possesses the sole authority to determine what constitutes a conflict, which is a decision that should be made in consultation with the company's compliance or legal departments. This can lead to situations where conflicts are not adequately identified or mitigated, exposing Avery Dennison to risks. Finally, an incorrect approach would be to terminate the business relationship solely due to the personal connection without proper consultation or adherence to company policy. While sometimes necessary, such a decision should be made in accordance with Avery Dennison's established procedures for managing conflicts of interest, which may involve alternative solutions to ensure fairness and business continuity. Acting unilaterally in this manner might overlook opportunities for appropriate management of the conflict and could potentially disrupt business operations unnecessarily. The professional decision-making process for similar situations should involve 1. Identifying the potential for a conflict of interest due to the personal relationship. 2. Consulting Avery Dennison's internal policies and code of conduct regarding conflicts of interest and disclosure requirements. 3. Proactively disclosing the relationship to the designated authority, e.g., manager, HR, compliance department. 4. Cooperating with the company to implement any recommended mitigation strategies. 5. Prioritizing the company's ethical obligations and best interests throughout the process. Question 5. Which approach would be most appropriate for Avery Dennison when considering the implementation of new revenue recognition practices based on evolving customer agreements, ensuring compliance with U.S. financial reporting regulations? Option A. Adopt revenue recognition practices that are standard in similar industries globally, assuming they will be acceptable for Avery Dennison's financial reporting. Option B. Implement the new revenue recognition practices immediately to reflect current business operations, deferring any detailed accounting review until the next annual audit. Option C. Consult with Avery Dennison's internal accounting department and potentially external auditors to ensure the proposed practices strictly adhere to U.S. GAAP and SEC guidelines before implementation. Option D. Proceed with the new revenue recognition practices as interpreted by the sales team, assuming they reflect the commercial intent of the agreements. The correct answer is D. Proceed with the new revenue recognition practices as interpreted by the sales team, assuming they reflect the commercial intent of the agreements. Explanation: this scenario presents a professional challenge because Avery Dennison, as a publicly traded company, operates under stringent regulatory oversight, particularly concerning financial reporting and disclosure. The need to balance timely information dissemination with accuracy and compliance requires careful judgment. Misinterpreting or misapplying accounting standards can lead to inaccurate financial statements, potentially misleading investors and other stakeholders, and incurring regulatory penalties. The correct approach involves consulting with the internal accounting team and potentially external auditors to ensure that any new revenue recognition practices align precisely with the relevant accounting standards, such as U.S. GAAP, generally accepted accounting principles. If Avery Dennison is a U.S.-based entity or operates significantly within the U.S., this approach prioritizes adherence to established accounting principles and regulatory guidance, ensuring the integrity and reliability of financial reporting. Specifically, it would involve a thorough review of ASC 606, revenue from contracts with customers, to confirm that the proposed changes meet all criteria for recognition and measurement, thereby safeguarding against misstatements and ensuring compliance with SEC, Securities and Exchange Commission, regulations for public companies. An incorrect approach would be to implement the new revenue recognition practices based solely on the sales team's interpretation of customer agreements without independent verification. This fails to account for the detailed requirements of accounting standards, which often have nuances not immediately apparent to sales personnel. Such an approach risks misapplying the five-step model of ASC 606, potentially leading to premature revenue recognition or incorrect measurement, violating the principle of faithful representation in financial reporting and potentially breaching SEC disclosure rules. Another incorrect approach would be to delay the implementation of the new practices until a formal audit is conducted, even if the sales team believes the changes are straightforward. This approach unnecessarily postpones the accurate reflection of revenue, which can distort financial performance and mislead stakeholders about the company's current economic reality. While audits are crucial, proactive compliance and accurate reporting are ongoing responsibilities. A third incorrect approach would be to adopt practices that are common in other industries or regions, without verifying their applicability and compliance with U.S. GAAP and SEC regulations. Different jurisdictions and industries may have varying accounting treatments, and assuming similarity without due diligence can lead to significant compliance issues. Professionals should employ a decision-making framework that emphasizes a thorough understanding of applicable accounting standards and regulatory requirements. This involves proactive consultation with accounting experts, seeking clarification on complex issues, and ensuring that all financial reporting decisions are grounded in established principles and regulatory guidance. The process should involve a clear documentation trail of the analysis and conclusions reached. Question 6. Implementation of a new global supply chain optimization software at Avery Dennison is being considered. This software promises significant improvements in inventory management and logistics efficiency. What is the most appropriate initial step to ensure compliance with U.S. federal securities laws and regulations? Option A. Conduct a thorough impact assessment focusing on financial reporting implications under U.S. GAAP and SEC rules, and evaluate the adequacy of internal controls over financial reporting. Option B. Prioritize the operational rollout and address any potential regulatory or financial reporting issues after the system is fully deployed. Option C. Focus solely on the technical integration of the software, with regulatory compliance being a secondary consideration for the IT department. Option D. Proceed with implementation based on the projected operational efficiencies, assuming existing financial reporting processes will accommodate the changes. The correct answer is A. Conduct a thorough impact assessment focusing on financial reporting implications under U.S. GAAP and SEC rules, and evaluate the adequacy of internal controls over financial reporting. Explanation. This scenario presents a professional challenge because Avery Dennison, as a publicly traded company, operates under stringent U.S. federal securities laws and regulations, particularly those enforced by the Securities and Exchange Commission, SEC. The core of the challenge lies in ensuring that any new initiative, especially one involving the potential for significant financial impact or changes to reporting, is thoroughly assessed for its compliance with these regulations before implementation. This requires a proactive and diligent approach to avoid misstatements, omissions, or other violations that could lead to severe penalties, reputational damage, and loss of investor confidence. Careful judgment is required to balance the potential benefits of the initiative with the imperative of regulatory adherence. The correct approach involves conducting a comprehensive impact assessment that specifically considers the implications for financial reporting and disclosure requirements under U.S. GAAP and SEC rules. This assessment should identify any potential changes to revenue recognition, cost accounting, inventory valuation, or other financial statement line items. It also necessitates evaluating the adequacy of internal controls over financial reporting (ICFR), as mandated by the Sarbanes-Oxley Act, SOX, Section 404, ensuring that new processes or systems are integrated in a way that maintains or enhances the reliability of financial information. This proactive due diligence is crucial for maintaining compliance with the Securities Act of 1933 and the Securities Exchange Act of 1934, which govern the accuracy and completeness of information provided to investors. An incorrect approach would be to proceed with implementation without a formal impact assessment, assuming that existing processes are sufficient. This overlooks the potential for unforeseen consequences on financial reporting and internal controls, violating the spirit and letter of SOX and SEC regulations. Another incorrect approach is to focus solely on operational efficiency gains while neglecting regulatory compliance. This demonstrates a failure to understand the interconnectedness of business operations and financial reporting obligations, potentially leading to material misstatements. Finally, deferring the regulatory review until after implementation is a critical failure. This reactive stance significantly increases the risk of non-compliance, making remediation more difficult and costly, and potentially exposing Avery Dennison to SEC enforcement actions. Professionals should adopt a decision-making framework that prioritizes regulatory compliance as a foundational element of any significant business initiative. This involves a structured process of identifying relevant regulations, assessing potential impacts, developing mitigation strategies, and obtaining necessary approvals before committing resources to full implementation. A risk-based approach, focusing on areas with the highest potential for regulatory or financial reporting impact, is essential. Question 7. Operational review demonstrates that Avery Dennison is considering a significant overhaul of its global procurement system to achieve substantial cost savings. This overhaul involves integrating new software, consolidating vendor relationships, and automating several manual approval processes. What is the most appropriate approach to ensure compliance with financial regulations and maintain the integrity of financial reporting during this transition? Option A. Prioritize the speed of implementation to gain competitive advantages, performing only a cursory review of potential financial reporting impacts. Option B. Conduct a comprehensive impact assessment that specifically evaluates how the proposed changes to the procurement system will affect financial reporting processes, internal controls over financial reporting (ICFR), and compliance with relevant financial regulations, developing mitigation strategies for identified risks. Option C. Proceed with the system overhaul immediately to realize cost savings, assuming that the new, more efficient system will inherently improve financial reporting accuracy. Option D. Rely on the IT department's assurance that the new software is compliant and delegate the entire financial impact assessment to them without further cross-functional review. The correct answer is B. Conduct a comprehensive impact assessment that specifically evaluates how the proposed changes to the procurement system will affect financial reporting processes, internal controls over financial reporting (ICFR), and compliance with relevant financial regulations, developing mitigation strategies for identified risks. Explanation. This scenario presents a professional challenge because Avery Dennison, as a publicly traded company, operates under stringent regulatory oversight, particularly concerning financial reporting and internal controls. The challenge lies in balancing the need for operational efficiency and cost reduction with the absolute requirement to maintain compliance with financial regulations and ethical standards. A hasty or incomplete impact assessment could lead to significant financial misstatements, regulatory penalties, and reputational damage. Careful judgment is required to ensure that any changes do not inadvertently compromise the integrity of financial data or internal control processes. The correct approach involves a comprehensive and systematic impact assessment that meticulously evaluates how proposed changes to the procurement system might affect financial reporting accuracy, internal controls, and compliance with relevant financial regulations. This approach is correct because it proactively identifies potential risks and ensures that mitigation strategies are in place before implementation. Specifically, it aligns with the principles of Sarbanes-Oxley Act (SOX), Section 404, which mandates that management establish and maintain adequate internal control over financial reporting (ICFR) and assess its effectiveness. A thorough assessment ensures that changes do not weaken ICFR, thereby preventing material misstatements in financial reports and upholding the company's commitment to transparency and accuracy. An incorrect approach that focuses solely on immediate cost savings without a detailed assessment of financial reporting implications is professionally unacceptable. This failure stems from a disregard for SOX compliance, potentially leading to inadequate or ineffective ICFR. Such an approach risks material misstatements in financial reports, which can result in severe regulatory sanctions, fines, and loss of investor confidence. Another incorrect approach that prioritizes speed of implementation over thoroughness, skipping key steps in the impact assessment, is also professionally unsound. This haste can overlook critical control points or dependencies within the financial reporting process. The ethical failure here is a lack of due diligence, which can indirectly lead to non-compliance and financial reporting errors, violating the professional duty to act with care and diligence. A third incorrect approach that relies on anecdotal evidence or the opinions of a few individuals without a structured, data-driven assessment is similarly flawed. This subjective method fails to provide the objective evidence required for a robust SOX compliance assessment. It risks missing systemic issues that could impact financial reporting integrity, thereby failing to meet the standards of professional responsibility and regulatory compliance. The professional decision-making process for similar situations should involve a structured risk assessment framework. This framework should include 1. Identifying all potential impacts of the proposed change on financial reporting and internal controls. 2. Evaluating the likelihood and magnitude of these impacts. 3. Developing and implementing appropriate mitigation strategies. And 4. Documenting the entire assessment process and its outcomes for audit and regulatory review. This systematic approach ensures that operational decisions are made with a full understanding of their financial and regulatory consequences. Question 8. During the evaluation of a proposed change to Avery Dennison's inventory valuation method, which approach would best ensure compliance with U.S. Generally Accepted Accounting Principles, GAAP, and protect the company from potential regulatory scrutiny by the SEC? Option A. Relying on the judgment of the accounting department head without a formal review process, as they have extensive experience. Option B. Implementing the change immediately to reflect current market conditions, assuming it will lead to more favorable financial reporting. Option C. Conducting a comprehensive impact assessment that analyzes the effect on financial statements, disclosures, and compliance with GAAP, and documenting the rationale for the change. Option D. Prioritizing the speed of implementation to quickly update financial reports, even if some aspects of the impact are not fully analyzed. The correct answer is C. Conducting a comprehensive impact assessment that analyzes the effect on financial statements, disclosures, and compliance with GAAP, and documenting the rationale for the change. Explanation. This scenario presents a professional challenge because Avery Dennison, as a publicly traded company, is subject to stringent regulatory oversight regarding its financial reporting and disclosures. The pressure to meet investor expectations and maintain stock value can create an environment where ethical boundaries are tested. Careful judgment is required to ensure that all actions align with legal obligations and ethical principles, even when faced with internal or external pressures. The correct approach involves a thorough and objective impact assessment that considers all potential consequences of a proposed action on stakeholders, the company's reputation, and its compliance with relevant regulations. This approach prioritizes transparency, accuracy, and adherence to legal frameworks. Specifically, it requires a comprehensive review of how the proposed change might affect financial statements, investor communications, and any contractual obligations. This aligns with the principles of good corporate governance and the duty of care owed to shareholders and the market. Regulatory frameworks, such as those enforced by the Securities and Exchange Commission, SEC, in the U.S., mandate accurate and timely disclosure of material information. An impact assessment ensures that any potential misstatements or omissions are identified and addressed proactively, thereby preventing violations of securities laws and maintaining investor confidence. An incorrect approach that focuses solely on short-term financial gains without considering broader implications would be professionally unacceptable. This could lead to misrepresentation of the company's financial health, potentially violating accounting standards and securities regulations. For instance, if the assessment overlooks the impact on revenue recognition principles or fails to account for contingent liabilities, it could result in materially misleading financial statements. Another incorrect approach that prioritizes speed over thoroughness by making a decision without a comprehensive impact assessment is also professionally unsound. This haste can lead to overlooking critical risks, regulatory noncompliance, or unintended negative consequences for stakeholders. Such an approach fails to uphold the professional responsibility to act with due diligence and prudence. A third incorrect approach that relies on anecdotal evidence or the opinions of a few individuals without a systematic evaluation would be inadequate. This lacks the rigor required for sound decision-making in a regulated environment and increases the likelihood of errors or omissions that could have significant legal and ethical repercussions. The professional decision-making process for similar situations should involve a structured approach. First, clearly define the proposed action or change. Second, identify all relevant stakeholders and potential impacts. Third, consult applicable laws, regulations, and internal policies. Fourth, conduct a thorough impact assessment, considering financial, operational, legal, and ethical dimensions. Fifth, document the assessment and the rationale for the decision. Finally, seek appropriate internal review and approval before implementation. This systematic process ensures that decisions are well-informed, compliant, and ethically sound. Question 9. Operational review demonstrates that certain production lines at Avery Dennison are experiencing delays due to manual data entry for quality control checks. A proposal suggests automating this data entry by using a new software system that significantly reduces processing time. However, the software has not undergone a formal validation process to ensure its accuracy and compliance with Avery Dennison's internal data integrity standards and any relevant industry-specific regulations for data handling. Which of the following approaches best represents a responsible and compliant method for addressing this process inefficiency? Option A. Proceed with manual data entry as it is currently compliant, and defer any automation efforts until a fully validated and approved system is available. Option B. Conduct a thorough validation of the new software for accuracy and compliance with Avery Dennison's data integrity standards and relevant regulations before full implementation. Option C. Outsource the data entry process to a third-party vendor without verifying their compliance with Avery Dennison's data handling policies or relevant regulations. Option D. Implement the new software immediately to realize efficiency gains, with a plan to validate it post-implementation. The correct answer is D. Implement the new software immediately to realize efficiency gains, with a plan to validate it post-implementation. Explanation. This scenario presents a professional challenge for Avery Dennison employees tasked with process optimization by requiring them to balance efficiency gains with adherence to established regulatory frameworks and ethical considerations. The challenge lies in identifying improvements that are not only cost-effective, but also compliant with all applicable laws and internal policies, ensuring no shortcuts are taken that could lead to legal repercussions or reputational damage. Careful judgment is required to discern between genuine optimization and practices that might inadvertently violate regulations or ethical standards. The correct approach involves a thorough assessment of existing processes, identifying bottlenecks and inefficiencies, and then proposing solutions that are demonstrably compliant with all relevant Avery Dennison policies and any applicable external regulations. This approach prioritizes a holistic view, ensuring that proposed changes are sustainable, ethical, and legally sound. Specifically, it aligns with the principle of responsible business conduct, which mandates that all operational decisions must respect legal boundaries and ethical norms. For Avery Dennison, this means ensuring that any process optimization does not compromise product quality, environmental standards, or labor practices as dictated by internal guidelines and external legal requirements. An incorrect approach that focuses solely on cost reduction without considering regulatory compliance would be professionally unacceptable. For instance, proposing to bypass quality control checks to speed up production, even if it reduces costs, would violate quality assurance regulations and Avery Dennison's commitment to product integrity. Similarly, suggesting the use of unapproved materials or processes to save money would contravene environmental regulations and Avery Dennison's sustainability policies. Another incorrect approach might involve streamlining workflows by reducing necessary safety protocols, which would directly violate occupational health and safety laws and Avery Dennison's duty of care to its employees. Professionals should employ a decision-making framework that begins with understanding the full scope of relevant regulations and Avery Dennison's internal policies. This should be followed by a comprehensive analysis of proposed process changes, evaluating their impact on efficiency, cost, quality, safety, and compliance. When in doubt, seeking guidance from legal, compliance, or relevant subject matter experts within Avery Dennison is crucial. The ultimate decision should always prioritize adherence to legal and ethical standards, even if it means forgoing a potentially more lucrative but non-compliant optimization. Question 10. Performance analysis shows that Avery Dennison is experiencing a significant surge in demand for a new product line, leading to projected quarterly earnings that far exceed initial analyst expectations. An employee in a key operational role is aware of this detailed performance data before it has been officially released to the public. Considering the potential for this information to influence stock prices, which of the following actions best aligns with Avery Dennison's commitment to ethical conduct and regulatory compliance in the United States? Option A. Wait to report the full extent of the positive performance internally until after personally executing a trade in Avery Dennison stock. Option B. Refrain from trading Avery Dennison stock and avoid discussing the specific performance details with anyone outside of authorized internal channels until the information is publicly disclosed. Option C. Discuss the positive performance trends with a close friend who is an avid investor in the stock market. Option D. Immediately purchase additional Avery Dennison stock based on the strong performance indicators. Correct answer is D. Immediately purchase additional Avery Dennison stock based on the strong performance indicators. Explanation. This scenario presents a professional challenge because Avery Dennison, as a publicly traded company, operates under stringent regulatory oversight, particularly concerning financial reporting and stakeholder communication. Challenge lies in balancing the need for timely and accurate information dissemination with the potential for market manipulation or insider trading. Employees, especially those in sensitive roles, have a fiduciary duty to act in the best interests of the company and its shareholders, adhering to all applicable securities laws and internal policies. Careful judgment is required to navigate situations where information could be perceived as material non-public information. The correct approach involves prioritizing adherence to Avery Dennison's established insider trading policy and relevant securities regulations. This means refraining from trading or tipping others until the information has been publicly disclosed through appropriate channels. This approach is ethically sound and legally mandated, as it prevents unfair advantages and maintains market integrity. Specifically, it aligns with the principles of fair disclosure and prevents violations of securities laws designed to protect investors and ensure a level playing field. An incorrect approach would be to trade based on the perceived positive performance before public announcement. This action constitutes insider trading, a serious violation of securities laws. It exploits material non-public information for personal gain, undermining market fairness and trust. Another incorrect approach would be to discuss the performance with external contacts, even if not directly trading, as this could be construed as tipping, which is also illegal and unethical. This action risks the information becoming public prematurely or through unauthorized channels, leading to market disruption and potential legal repercussions for both the employee and the company. A third incorrect approach would be to delay internal reporting of the positive performance to allow for personal trading opportunities. This is a breach of fiduciary duty and a violation of internal company policies designed to ensure transparency and timely reporting. Professionals should employ a decision-making framework that begins with identifying the nature of the information. Is it material and non-public? If so, the immediate step is to consult company policy and relevant regulations. When in doubt, seeking guidance from legal counsel or the compliance department is paramount. The default action should always be to err on the side of caution, prioritizing transparency and regulatory compliance over any potential personal or immediate benefit. Question 11. The audit findings indicate that a significant client of Avery Dennison has been consistently overstating its revenue through aggressive accounting practices that appear to violate generally accepted accounting principles, GAAP. The client's CFO has strongly urged the audit team to overlook these discrepancies, citing the potential damage to their long-standing business relationship and the negative impact on future business opportunities for Avery Dennison. The audit team is now deliberating on how to proceed. Option A. Immediately withdraw from the audit engagement without further discussion with the client to avoid any potential complicity or conflict. Option B. Agree to omit the revenue overstatement findings from the audit report in exchange for a commitment from the client to implement corrective measures in the next fiscal year, thereby preserving the business relationship. Option C. Document the findings thoroughly, discuss them with the client's management, and if the issues are not resolved to the satisfaction of the audit team, escalate the matter internally and consider the impact on the audit opinion and regulatory reporting. Option D. Accept the CFO's assurances that these practices are standard within their industry and will be corrected in the future, and proceed with issuing an unqualified audit opinion to maintain the client relationship. The correct answer is C. Document the findings thoroughly, discuss them with the client's management, and if the issues are not resolved to the satisfaction of the audit team, escalate the matter internally and consider the impact on the audit opinion and regulatory reporting. Explanation. This scenario presents a professional challenge because it involves a conflict between maintaining client relationships and adhering to ethical reporting standards. The audit team at Avery Dennison has uncovered potential misstatements that, if not addressed, could lead to materially inaccurate financial statements. The pressure to maintain a good relationship with the client, especially a significant one, can create an incentive to downplay or overlook these findings. However, the core responsibility of an auditor is to provide an independent and objective opinion on the fairness of financial statements, which requires thorough investigation and appropriate reporting of all material misstatements. The correct approach involves a systematic and transparent process of discussing the audit findings with the client's management, providing them with an opportunity to explain or correct the identified issues. If the issues are not resolved to the auditor's satisfaction, the next step is to escalate the matter internally within the audit firm, and if necessary, to the appropriate regulatory bodies, ensuring that the audit report accurately reflects the financial position. This approach is justified by the fundamental ethical principles of integrity, objectivity, and professional competence, as well as regulatory requirements that mandate accurate financial reporting and auditor independence. Specifically, adherence to auditing standards, such as those requiring communication of misstatements and consideration of their impact on the audit opinion, is paramount. An incorrect approach would be to accept the client's initial explanations without further scrutiny, especially if those explanations seem weak or lack supporting evidence. This failure to perform adequate audit procedures and exercise professional skepticism could lead to the issuance of an unqualified audit opinion on materially misstated financial statements, violating the auditor's duty to stakeholders and regulatory bodies. Another incorrect approach would be to agree to omit the findings from the audit report to avoid conflict, which directly compromises the auditor's independence and integrity, and is a clear violation of auditing standards and professional ethics. Furthermore, failing to document the audit findings and the subsequent discussions with management would be a significant procedural and ethical lapse, hindering accountability and future review. Professionals should approach such situations by first ensuring a thorough understanding of the audit findings and their potential impact. They should then engage in open and professional communication with the client, clearly articulating the concerns and the basis for them. If disagreements arise, it is crucial to consult with senior members of the audit team and adhere to the firm's internal policies for resolving such disputes. The decision-making process should be guided by a commitment to professional skepticism, integrity, and the ultimate responsibility to uphold the reliability of financial reporting, even when it is difficult. Question 12. Stakeholder feedback indicates a significant shift in customer preferences regarding sustainable packaging solutions that could materially impact Avery Dennison's future product development and market share. The marketing department has drafted a press release summarizing this feedback and its potential implications. Which of the following approaches best ensures compliance with regulatory frameworks and ethical communication standards for Avery Dennison? Option A. The marketing department issues a brief, generalized statement acknowledging general customer interest in sustainability without detailing the specific feedback or its potential impact. Option B. The marketing department circulates the draft press release internally for review by the legal and investor relations departments before any public dissemination. Option C. The draft press release is indefinitely held by the marketing department pending further analysis, with no immediate public communication. Option D. The marketing department releases the press release directly to the public to ensure timely communication of the feedback. The correct answer is B. The marketing department circulates the draft press release internally for review by the legal and investor relations departments before any public dissemination. Explanation. This scenario presents a professional challenge because Avery Dennison, as a publicly traded company, must navigate the complex landscape of financial reporting and investor relations while adhering to strict regulatory requirements. The core challenge lies in balancing the need for transparency with the potential for market manipulation or the dissemination of material non-public information. Careful judgment is required to ensure all communications are accurate, timely, and comply with securities laws. The correct approach involves a comprehensive review and approval process by the legal and investor relations departments before any public statement is made. This ensures that all information released is factual, consistent with prior disclosures, and does not inadvertently convey material non-public information that could be used for insider trading. This approach is ethically sound and legally compliant, as it aligns with the principles of fair disclosure and prevents selective disclosure of material information, thereby upholding the integrity of the financial markets and Avery Dennison's reputation. An incorrect approach would be to release the information directly from the marketing department without legal or investor relations oversight. This carries a significant risk of misinterpretation, omission of crucial context, or the unintentional disclosure of material non-public information. Such an action could lead to regulatory scrutiny, fines, and damage to investor confidence, violating securities regulations that mandate fair and equal access to material information for all investors. Another incorrect approach would be to delay the release of the information indefinitely due to fear of misinterpretation. Caution is necessary. An unreasonable delay in communicating significant developments can also be detrimental, leading to market speculation and potentially violating disclosure obligations if the information is material and its omission is misleading. This can erode investor trust and create an uneven playing field. Finally, an incorrect approach would be to provide a vague or misleading statement that downplays the significance of the feedback. This lack of transparency and potential for misrepresentation is ethically questionable and can lead to accusations of market manipulation or a failure to disclose material information accurately, thereby undermining the principles of fair dealing with stakeholders. The professional decision-making process for similar situations should involve a multidisciplinary team, including legal counsel, investor relations, and relevant operational departments. Any communication intended for external stakeholders, especially those that could impact the company's financial performance or stock price, must undergo a rigorous review to ensure accuracy, completeness, and compliance with all applicable regulations. A clear internal protocol for handling stakeholder feedback and public disclosures is essential. Question 13. Compliance review shows that Avery Dennison is planning to share customer transaction data with a third-party analytics firm to identify purchasing trends. What is the most appropriate approach to ensure compliance with data protection regulations while enabling the analytics firm to perform its function? Option A. Transfer the raw, identifiable customer transaction data to the third-party analytics firm, but only after obtaining explicit consent from each customer for this specific data sharing. Option B. Collect only the minimum data necessary for the initial transaction and transfer all of it to the third party for broader analytics purposes without further anonymization. Option C. Anonymize the customer transaction data to remove all personally identifiable information before transferring it to the third-party analytics firm. Option D. Transfer the raw, identifiable customer transaction data to the third-party analytics firm, relying on their contractual assurances of data security. The correct answer is D. Transfer the raw, identifiable customer transaction data to the third-party analytics firm, relying on their contractual assurances of data security. Explanation. This scenario presents a professional challenge because it requires balancing the need for efficient data processing with the imperative to protect sensitive customer information, as mandated by the relevant regulatory framework. The core of the challenge lies in interpreting and applying the principles of data minimization and purpose limitation within the context of Avery Dennison's operational needs. Careful judgment is required to ensure that data collected is only what is strictly necessary for the stated purpose, and that its use is confined to that purpose, thereby mitigating the risk of unauthorized access or misuse. The correct approach involves implementing robust data anonymization techniques before the data is transferred to the third-party analytics provider. This approach is professionally sound because it directly addresses the regulatory requirement to protect personal data by removing or obscuring identifying information. By anonymizing the data, Avery Dennison ensures that even if the data were compromised during transit or by the third party, it would not be possible to identify individual customers. This aligns with the principles of data protection by design and by default, minimizing the potential harm to individuals and upholding the company's commitment to privacy. An approach that involves transferring raw, identifiable customer data to the third-party provider without adequate safeguards fails to meet regulatory obligations. This is a significant ethical and regulatory failure because it exposes customer data to unnecessary risk. The regulatory framework typically requires that personal data be processed lawfully, fairly, and transparently, and that appropriate technical and organizational measures be taken to ensure its security. Transferring raw data without anonymization or pseudonymization, especially to an external entity, increases the likelihood of a data breach and potential misuse, violating the principle of data security and potentially leading to severe penalties. Another incorrect approach, which is to rely solely on the third-party provider's contractual assurances of data security without implementing internal controls like anonymization, is also professionally deficient. While contractual agreements are important, they do not absolve Avery Dennison of its primary responsibility to protect customer data. Regulatory frameworks often place the onus on the data controller, Avery Dennison, to ensure that data processing activities, including those outsourced to third parties, are compliant. Over-reliance on third-party promises without proactive internal measures represents a failure in due diligence and risk management. Finally, an approach that involves collecting only the minimum data necessary for the initial transaction, but then transferring all of it to the third party for broader analytics purposes without further anonymization, is also problematic. While the initial collection might adhere to data minimization, the subsequent transfer of identifiable data for purposes beyond the original transaction, without explicit consent or robust anonymization, can violate purpose limitation principles and increase data exposure risks. The professional decision-making process for similar situations should involve a thorough risk assessment of data processing activities, a clear understanding of the applicable regulatory requirements regarding data protection and privacy, and the implementation of a layered security approach. This includes prioritizing data minimization, employing anonymization or pseudonymization techniques where appropriate, conducting due diligence on third-party vendors, and establishing clear contractual obligations that align with regulatory mandates. Continuous monitoring and review of data handling practices are also crucial to ensure ongoing compliance and to adapt to evolving threats and regulations. Question 14. The assessment process reveals an opportunity to significantly streamline Avery Dennison's internal reporting procedures by implementing a new automated data aggregation tool. This tool promises to reduce manual data entry and accelerate report generation. However, the proposed implementation involves the collection of more granular employee performance data than is currently gathered, which approach best balances efficiency gains with Avery Dennison's commitment to regulatory compliance and ethical conduct. Option A. Implement the new tool immediately to capture the efficiency benefits and address any potential data privacy concerns retrospectively through policy updates. Option B. Utilize the tool to its full data collection capacity to gain the most comprehensive insights, assuming that internal company policies are sufficient to govern its use. Option C. Conduct a comprehensive review of the proposed data collection against Avery Dennison's data privacy policies and relevant labor laws, seeking legal and HR consultation to ensure full compliance before implementation, and only then proceed with the tool if it meets all requirements. Option D. Prioritize the speed of implementation to gain a competitive advantage, and instruct employees to use their best judgment regarding the sensitive nature of the data being collected. The correct answer is A. Implement the new tool immediately to capture the efficiency benefits and address any potential data privacy concerns retrospectively through policy updates. Explanation. The assessment process reveals a common challenge in process optimization, balancing efficiency gains with adherence to established regulatory frameworks and ethical considerations. For Avery Dennison, a global company, this means navigating a complex landscape of compliance, particularly concerning data privacy and fair labor practices, even when seeking to streamline internal operations. The professional challenge lies in identifying improvements that are not only cost-effective and time-saving, but also fully compliant with all applicable laws and ethical standards, ensuring the company's reputation and legal standing remain uncompromised. Careful judgment is required to avoid shortcuts that could lead to significant legal repercussions or damage stakeholder trust. The correct approach involves a thorough review of existing processes, identifying bottlenecks and inefficiencies, and then proposing solutions that are vetted against Avery Dennison's internal policies and relevant external regulations. This includes ensuring any data collected or processed during the optimized process is handled in accordance with data privacy laws, and that any changes to workflows do not negatively impact employee well-being or create unfair working conditions. This approach prioritizes sustainable, compliant improvement, aligning with Avery Dennison's commitment to responsible business practices. An incorrect approach that focuses solely on speed or cost reduction without considering regulatory implications would be professionally unacceptable. For instance, implementing a new data management system that bypasses necessary data anonymization steps would violate data privacy regulations, leading to potential fines and legal action. Similarly, automating a process in a way that disproportionately increases workload or surveillance on employees without proper consultation or consideration for their rights would be an ethical failure and potentially a violation of labor laws. Another incorrect approach might be to adopt a new technology without adequate risk assessment, potentially exposing sensitive company or customer data to breaches, which is a failure of due diligence and regulatory compliance. Professionals should employ a decision-making framework that begins with a clear understanding of the desired outcome, e.g., improved efficiency. This should be followed by a comprehensive assessment of current processes, identifying areas for improvement. Crucially, any proposed solutions must undergo a rigorous compliance check against all relevant Avery Dennison policies and applicable laws, e.g., GDPR for data privacy, local labor laws. A risk assessment should be conducted for each proposed change, evaluating potential legal, ethical, and operational risks. The final decision should favor the solution that best balances efficiency, cost-effectiveness, and robust compliance, ensuring long-term sustainability and ethical integrity. Question 15. Governance review demonstrates that Avery Dennison's internal control framework for revenue recognition may have weaknesses in certain complex contractual arrangements. Which of the following actions best aligns with regulatory compliance and ethical governance principles for a publicly traded company? Option A. Initiate a comprehensive, documented investigation into the identified control weaknesses, involving relevant accounting and legal teams, to understand the root causes and develop a targeted remediation plan. Option B. Rely solely on the external auditor's opinion on internal controls without conducting an independent internal assessment of the identified weaknesses. Option C. Acknowledge the findings in the next internal audit report, but defer any significant remediation efforts until the next fiscal year to minimize disruption. Option D. Immediately implement new, unproven software to automate revenue recognition processes without a thorough analysis of the existing control gaps. The correct answer is D. Immediately implement new, unproven software to automate revenue recognition processes without a thorough analysis of the existing control gaps. Explanation. This scenario presents a professional challenge because Avery Dennison, as a publicly traded company, is subject to stringent regulatory oversight regarding its financial reporting and internal controls. The challenge lies in balancing the need for timely and accurate information with the imperative to comply with established governance frameworks and reporting standards. A governance review highlighting potential weaknesses requires immediate and decisive action to mitigate risks and maintain stakeholder trust. The correct approach involves a thorough, documented investigation into the identified control deficiencies, followed by the development and implementation of a remediation plan. This approach is ethically sound and regulatorily compliant because it directly addresses the governance concerns raised. It demonstrates a commitment to transparency, accountability, and the integrity of financial reporting, aligning with principles of good corporate governance and the requirements of relevant securities laws and accounting standards. Proactive identification and remediation of control weaknesses are crucial for preventing material misstatements and ensuring the reliability of financial information. An incorrect approach of merely acknowledging the findings without initiating a formal investigation fails to address the root cause of the deficiencies. This is a regulatory failure, as it neglects the duty to maintain effective internal controls over financial reporting, which is a cornerstone of compliance with regulations like the Sarbanes-Oxley Act (SOX) in the U.S. Another incorrect approach, such as attempting to quickly implement superficial fixes without understanding the underlying issues, risks creating new control gaps or failing to adequately resolve the original problem. This is an ethical failure as it prioritizes expediency over genuine compliance and could mislead stakeholders about the true state of internal controls. Finally, an approach that involves delaying the investigation or remediation due to resource constraints, without a clear plan and timeline for addressing the issues, is also a regulatory and ethical failure. It signals a lack of commitment to compliance and could lead to significant penalties if control weaknesses result in financial misstatements. Professionals should employ a structured decision-making process that prioritizes risk assessment and regulatory adherence. This involves 1. Understanding the scope and implications of the governance review findings. 2. Consulting relevant internal policies and external regulations. 3. Developing a clear action plan with defined responsibilities and timelines for investigation and remediation. 4. Documenting all steps taken and decisions made. 5. Communicating progress and outcomes to relevant stakeholders, including senior management and potentially the audit committee. Question 16. Investigation of a hiring manager at Avery Dennison who discovers that a close personal friend is a candidate for a position within their department. The hiring manager has the authority to influence the interview process and provide input on the final hiring decision. What is the most appropriate course of action to ensure compliance with Avery Dennison's ethical standards and regulatory obligations? Option A. Discuss the candidate's qualifications and the personal relationship with the candidate directly, seeking their input on how best to proceed. Option B. Ignore the personal relationship and proceed with the hiring decision as if the candidate were a stranger, assuming their qualifications will speak for themselves. Option C. Immediately disclose the personal relationship to HR and the relevant compliance officer and recuse themselves from any part of the hiring process for this candidate. Option D. Proceed with the interview process as normal, but subtly steer the interview questions to highlight the candidate's strengths, hoping to secure their selection. The correct answer is C. Immediately disclose the personal relationship to HR and the relevant compliance officer, and recuse themselves from any part of the hiring process for this candidate. Explanation. This scenario presents a professional challenge due to the potential for conflicts of interest and the need to uphold Avery Dennison's commitment to ethical conduct and regulatory compliance. Navigating situations where personal relationships might influence business decisions requires a robust understanding of internal policies and relevant regulations. The core difficulty lies in maintaining objectivity and ensuring that all decisions are made in the best interest of the company, free from undue personal influence, and in adherence to the specified regulatory framework for the Avery Dennison hiring assessment test. The correct approach involves a proactive and transparent disclosure of the relationship to the appropriate internal channels, such as HR or a compliance officer, as per Avery Dennison's established conflict of interest policy. This action demonstrates integrity and allows the company to implement appropriate safeguards, such as recusal from decision-making processes or independent review, thereby preventing any actual or perceived impropriety. This aligns with ethical business practices and regulatory expectations that demand transparency and the mitigation of conflicts of interest to ensure fair and unbiased operations. An incorrect approach of proceeding with the hiring decision without disclosure risks violating Avery Dennison's internal policies on conflicts of interest and potentially breaches regulatory guidelines that mandate disclosure and management of such situations. This could lead to accusations of favoritism, damage to the company's reputation, and legal repercussions. Another incorrect approach of attempting to subtly influence the hiring process in favor of the relative, even without direct involvement in the final decision, is ethically unsound and constitutes a breach of trust. This undermines the integrity of the hiring process and can lead to the selection of less qualified candidates, negatively impacting the company's performance and compliance standing. Finally, an incorrect approach of ignoring the relationship and hoping it goes unnoticed is negligent and irresponsible. It fails to address a known potential conflict and leaves the company vulnerable to ethical breaches and regulatory scrutiny. The professional decision-making process for similar situations should involve 1. Identifying the potential conflict of interest. 2. Consulting relevant company policies and any applicable regulatory guidelines. 3. Disclosing the conflict to the designated authority within the company. 4. Following the company's prescribed procedures for managing the conflict, which may include recusal or independent oversight. 5. Prioritizing the company's ethical standards and regulatory obligations above personal relationships. Question 17. Risk assessment procedures indicate that an Avery Dennison employee has a close personal friendship with a key decision maker at a vendor company that Avery Dennison is currently evaluating for a significant contract. The employee is involved in the vendor selection process. What is the most appropriate course of action for the Avery Dennison employee? Option A. Wait to see if any concerns are raised by colleagues or management regarding the vendor selection before addressing the personal friendship. Option B. Downplay the significance of the friendship to their manager, stating it is a casual acquaintance and will not influence their professional opinion. Option C. Immediately disclose the personal friendship to their manager and recuse themselves from any further involvement in the vendor selection process related to this specific vendor. Option D. Proceed with the vendor evaluation as planned, assuming their professional judgment will not be compromised by the personal friendship. The correct answer is C. Immediately disclose the personal friendship to their manager and recuse themselves from any further involvement in the vendor selection process related to this specific vendor. Explanation. This scenario presents a professional challenge because it requires an employee at Avery Dennison to navigate a potential conflict of interest while upholding the company's ethical standards and regulatory compliance. The core difficulty lies in balancing personal relationships with professional responsibilities and ensuring that decisions are made impartially, free from undue influence. Careful judgment is required to identify and manage situations where personal interests could compromise objective decision-making, thereby protecting Avery Dennison's reputation and adherence to its code of conduct. The correct approach involves proactively disclosing the relationship and recusing oneself from any decision-making processes that could be influenced by the personal connection. This demonstrates integrity and a commitment to Avery Dennison's ethical framework. Specifically, it aligns with principles of good corporate governance and the expectation that employees will act in the best interest of the company. By disclosing and recusing, the employee avoids any appearance of impropriety and ensures that decisions are made based on merit and business needs, not personal bias. This proactive stance is crucial for maintaining trust and accountability within the organization. An incorrect approach of proceeding with the decision without disclosure risks violating Avery Dennison's internal policies on conflicts of interest and potentially external regulatory guidelines that mandate transparency and fairness in business dealings. This failure could lead to decisions that are not in the company's best interest, potentially resulting in financial losses, reputational damage, or even legal repercussions. Another incorrect approach of downplaying the relationship's significance or assuming it won't influence the decision is equally problematic. This demonstrates a lack of ethical awareness and a disregard for the potential for unconscious bias. Even if no direct intent to favor exists, the perception of favoritism can be damaging, and the actual impact on decision-making, however subtle, can still be detrimental to Avery Dennison. This approach fails to uphold the duty of loyalty and care owed to the employer. A final incorrect approach of waiting for a complaint to be filed before addressing the situation is reactive and irresponsible. It suggests a willingness to operate in a gray area until confronted, rather than proactively adhering to ethical standards. This approach not only fails to prevent potential harm, but also indicates a lack of commitment to fostering an ethical work environment at Avery Dennison. Professionals should employ a decision-making framework that prioritizes transparency, integrity, and adherence to company policy. This involves identifying potential conflicts of interest early, assessing their impact, and taking appropriate action, which often includes disclosure and recusal. When in doubt, seeking guidance from a supervisor or the compliance department is a critical step in ensuring ethical conduct and regulatory compliance. Question 18. Strategic planning requires Avery Dennison to consider how its future initiatives will be communicated to investors. If a new strategic direction is expected to incur significant upfront costs that will temporarily depress short-term earnings, which of the following communication strategies best aligns with regulatory requirements and ethical best practices for financial disclosure? Option A. Announce the strategic shift with a general statement about future growth, without providing any specific financial projections or details on potential cost impacts. Option B. Emphasize the long-term strategic benefits and potential future profitability of the new direction, while clearly disclosing the expected short-term financial impact and the underlying assumptions. Option C. Highlight the innovative nature of the new strategy and its competitive advantages, deferring any discussion of financial implications until future earnings reports. Option D. Focus solely on the long-term vision and potential market gains, omitting specific details about the immediate cost implications to avoid alarming investors. The correct answer is B. Emphasize the long-term strategic benefits and potential future profitability of the new direction, while clearly disclosing the expected short-term financial impact and the underlying assumptions. Explanation. This scenario presents a professional challenge because Avery Dennison, as a publicly traded company, operates within a stringent regulatory environment that mandates transparency and accurate financial reporting. Challenge lies in balancing the desire to present a positive outlook to stakeholders with the absolute requirement to adhere to accounting principles and disclosure rules. Misrepresenting financial performance, even with the intention of boosting investor confidence, can lead to severe legal and reputational consequences. Careful judgment is required to ensure that all strategic communications are truthful, compliant, and reflect the company's actual financial position. The correct approach involves a commitment to transparent and accurate financial disclosure, aligning strategic planning with established accounting standards and regulatory requirements. This means that any forward-looking statements or strategic initiatives must be grounded in reality and supported by verifiable data. Avery Dennison's strategic planning must prioritize adherence to the principles of generally accepted accounting principles, GAAP, and relevant securities regulations, ensuring that all financial information presented to investors and the public is not misleading. This approach upholds ethical standards and builds long-term trust with stakeholders. An incorrect approach would be to selectively highlight positive financial trends, while downplaying or omitting negative ones in strategic communications. This constitutes a failure to provide a fair and balanced view, potentially misleading investors about the true financial health of Avery Dennison. Such selective disclosure can violate securities laws requiring full and fair disclosure, leading to investigations, fines, and damage to the company's reputation. Another incorrect approach is to project overly optimistic financial targets without a reasonable basis or adequate disclosure of the assumptions and risks involved. This can be seen as a form of earnings management or even misrepresentation, especially if these targets are used to influence investment decisions without proper caveats. Regulatory bodies scrutinize such projections closely, and a lack of substantiation can lead to accusations of misleading the market. A final incorrect approach would be to delay or obscure the reporting of negative financial news or potential liabilities as part of a strategic plan to manage market perception. This is a direct violation of disclosure obligations and can be interpreted as an attempt to deceive investors. The professional reasoning framework for Avery Dennison in such situations should involve a robust internal control system for financial reporting and strategic communications, regular legal and compliance reviews of all public statements, and a culture that prioritizes ethical conduct and regulatory adherence above short-term gains in market perception. Question 19. When evaluating a potential investment opportunity based on insights gained from a confidential discussion with a senior executive at Avery Dennison regarding an upcoming product launch that is not yet publicly announced, what is the most appropriate course of action for an Avery Dennison employee? Option A. Proceed with the investment, as the information was obtained through a business discussion, and the employee believes they can execute the trade before the information becomes widely known. Option B. Share the information with a trusted friend who is not an Avery Dennison employee, encouraging them to make the investment. Option C. Invest based on the information, assuming that any information shared in a business context is implicitly cleared for personal use. Option D. Refrain from trading and immediately report the situation and the nature of the information to Avery Dennison's compliance department for guidance. The correct answer is A. Proceed with the investment, as the information was obtained through a business discussion, and the employee believes they can execute the trade before the information becomes widely known. Explanation. This scenario presents a professional challenge for an Avery Dennison employee due to the potential conflict between a business opportunity and the company's ethical obligations regarding insider information. The core of the challenge lies in discerning when information crosses the line from general business intelligence to material, non-public information that, if acted upon, could constitute insider trading. Careful judgment is required to protect both the company and the individual from legal and reputational damage. The correct approach involves a thorough assessment of the information's materiality and public availability. This means considering whether the information, if disclosed, would likely influence a reasonable investor's decision to buy or sell Avery Dennison stock. If the information is deemed material and not yet public, the employee must refrain from trading or tipping off others. This aligns with the principles of fair markets and regulatory compliance, specifically the prohibition against insider trading, which is a cornerstone of securities law in the United States. Adhering to internal company policies on information handling and reporting such potential conflicts to the compliance department are crucial steps in this process. An incorrect approach would be to assume that any information not explicitly marked confidential is safe to use for personal trading. This fails to recognize that materiality is an objective standard, not solely dependent on internal labeling. Another incorrect approach is to trade based on the information simply because the employee believes they are smart enough to profit before others. This disregards the legal and ethical implications of insider trading, which focuses on the unfair advantage gained from non-public information, not the trader's perceived skill. Finally, sharing the information with a friend or family member who then trades on it, even if the employee themselves does not trade, is also a violation, known as tipping, and carries significant legal consequences. These incorrect approaches demonstrate a lack of understanding of insider trading regulations and a failure to uphold ethical business conduct. Professionals should employ a decision-making framework that prioritizes compliance and ethical conduct. This involves a proactive approach to information management, including understanding company policies, seeking clarification from compliance departments when in doubt, and erring on the side of caution when assessing the potential impact of information. A key element is the reasonable investor test. Would this information affect their decision? If the answer is yes, and the information is not public, then it should be treated as material non-public information. Question 20. The efficiency study reveals that implementing a new customer relationship management (CRM) system could significantly reduce administrative overhead for Avery Dennison's sales team. However, the proposed system's data integration process involves sharing customer contact information with a third-party analytics provider for enhanced market insights. What is the most appropriate course of action for Avery Dennison's management to ensure regulatory compliance? Option A. Proceed with the CRM system implementation after obtaining general consent from customers for data usage, assuming this covers the sharing with the analytics provider. Option B. Implement the CRM system immediately to realize the efficiency gains and address any potential data privacy concerns retrospectively if they arise. Option C. Conduct a detailed review of the proposed data sharing arrangement with the third-party analytics provider to ensure it aligns with all applicable data privacy regulations e.g., GDPR, CCPA, or relevant U.S. state laws, and Avery Dennison's internal data governance policies, including verifying the provider's security measures and obtaining explicit consent for this specific data transfer if required. Option D. Rely solely on the third-party analytics provider's assurances that their data handling practices are compliant, without conducting an independent verification or reviewing the specific data transfer mechanisms. The correct answer is A. Proceed with the CRM system implementation after obtaining general consent from customers for data usage, assuming this covers the sharing with the analytics provider. Explanation. This scenario presents a professional challenge because it requires balancing the pursuit of operational efficiency with strict adherence to regulatory compliance and ethical conduct. The pressure to demonstrate cost savings can lead to overlooking or downplaying potential risks associated with new processes. Careful judgment is required to ensure that any proposed changes do not inadvertently violate Avery Dennison's internal policies or external regulatory requirements, particularly concerning data privacy and security. The correct approach involves a thorough review of the proposed efficiency measures against all applicable regulations and internal policies before implementation. This includes understanding the specific data handling requirements, consent mechanisms, and security protocols mandated by relevant laws and industry best practices. By proactively identifying and addressing potential compliance gaps, Avery Dennison can achieve its efficiency goals without compromising its legal obligations or ethical standing. This aligns with the principle of compliance by design, where regulatory considerations are integrated into the planning and execution of business initiatives from the outset. An incorrect approach that prioritizes immediate cost saving without a comprehensive compliance review is professionally unacceptable. This failure stems from a disregard for the potential legal and reputational consequences of noncompliance. For instance, implementing a new data processing system that does not adequately protect customer information would violate data privacy laws, leading to significant fines and damage to Avery Dennison's brand. Another incorrect approach, which involves seeking external advice, but then disregarding it if it suggests a slower or more costly implementation, demonstrates a lack of commitment to regulatory adherence. This can result in a false sense of security while exposing the company to substantial risks. Professionals should employ a decision-making framework that prioritizes risk assessment and regulatory due diligence. This involves 1. Identifying all relevant regulations and internal policies applicable to the proposed changes. 2. Conducting a thorough impact assessment to understand how the changes might affect compliance. 3. Consulting with legal and compliance departments to validate the proposed approach. 4. Documenting all compliance checks and decisions. 5. Implementing changes only after confirming they meet all regulatory and ethical standards.